Here are a few chart patterns to look for when using technical stock analysis to stay ahead of market trends. I found this article by Sean Hannon on StockTrader.com, and I will include a link to the article in the description. The first chart pattern is gaps. Gaps occur when a stock price opens much higher or lower than the previous day's close. Once a gap occurs, the new price represents an important price level. Gaps higher create support that should allow the stock to move higher, and gaps lower create resistance that should pressure the stock lower. Until the gap is violated, we should assume the trend will continue in the gap's direction. Amazon.com shows a gap higher on heavy volume that now acts as support. Volume is a confirmation of the bullish signal of the upward gap. As the stock has traded higher from that moment, it would take a close below 57.50 to indicate the bullish move is over. The next chart pattern is head and shoulders. This is a powerful pattern that marks a top and also provides a downside price target. When a head and shoulders forms, we see a rise within an existing upward trend to a new high that creates the left shoulder. Prices then move lower but rebound to another new high to form the head. From that point, we see a decline that does not violate the initial sell-off from the left shoulder. Prices rally again, but the failure to top the recent high forms the right shoulder. By connecting the lows that occurred after the left shoulder and head were formed, we identify the neckline. Once the neckline is violated, the pattern is complete and the prices will move lower. To see this pattern in action, consider the volatility index. In October, a strong uptrend took the VIX near 80 before a sell-off. This formed the left shoulder. A rally above 80 and subsequent decline created the head. When VIX then topped out near 70, the right shoulder was formed. The breaking of the blue neckline pointed to lower prices. To estimate the downside target, we use the difference between the head and the neckline. This gives us a 35 target marked by the blue box. The third chart pattern is the triple bottom or triple top. This is a variation of a head and shoulders pattern. The main difference is that whereas the head and shoulders offers 3 points at different prices, the triple top or bottom offers them at the same price. Cliff Natural Resources shows 3 highs at the same level marked by blue circles. This indicates a potential triple top that would drive prices towards $20. The next chart pattern is double bottom or double top. This is more frequent as it only requires 2 data points, whereas the triple top and head and shoulders require 3 points. When we see 2 prices at the same level, it indicates stocks have reached either a top or bottom. As with most technical patterns, reversals on heavy volume reinforce the movement. Returning to Coca-Cola, the black circle indicates a spike in volume that accompanied the reversal. This should have warned all those owning the shares that the massive reversal was occurring. The final chart pattern is saucers. Saucers show a gradual turn from downtrend to sideways to uptrend. They are long-lasting base-building patterns that indicate trends are changing. Copper offers an example whereby a long downtrend eventually bottomed, moved sideways, and then pushed higher. This lets us know that the recent lows near $130 should serve as a long-term base years into the future. Thank you guys for watching this video. If you thought this information was useful, please check out the full article on StockTrader.com. I came across this article and I thought this information was worth sharing, so I pretty much took the article and turned it into a video for you guys. If you have any questions, please drop them in the comments and I'll be sure to answer those. And as always, thank you guys for watching.